Welcome, everyone. Today, I'm really excited for this presentation. It is called Life Insurance Fundamentals. And I'm doing this presentation because every September is Life Insurance Awareness Month. And I think it's just something that people have heard about. They might, have a policy that their grandmother might have gotten for them a long time ago. Or maybe something at the job. You might have established some type of life insurance awareness. Life insurance through the workplace. And most times what I find is that a lot of folks don't really understand the ins and outs of the fundamentals of life insurance and how it works and how to get it and all the different types. And that's what I want to just go over through tonight. And we'll be done within the hour, but it's just a really, in my opinion, probably one of the most underrated financial product and service that a lot of folks do not take advantage of, but that probably 99% of the population actually need. So let me go ahead and jump into this. For those of you who don't know me, or if this is your first time connecting with me, my name is Shantae Moore. I am a certified financial educator, an investment advisor representative, a certified college consultant. I've actually been in the financial industry almost 20 years. So I've accumulated a lot of experience and professional licensing and certifications. But overall, I just teach people how money works. I really take pride in my ability to break down these big financial complicated topics and make them simple, make them engaging, make them fun to learn. If you're not connected with me already, here's my contact information here on the screen. I actually have quite a few websites, but the main one that I use is called howmoneyworks.com/Shantae W. Moore. You can email me. Actually, if you were personally invited from me, it's because you're on my email list, and hopefully someone might have shared this information with you. So quick disclaimer, because I'm trying to fit in a lot of information about life insurance in 1 hour, you won't learn everything about life insurance, but you will be definitely educated. I hope you walk away much more empowered and actually ready to evaluate your insurance situation. But if I go through examples, they're just that, they're hypothetical. I don't want you to take any information of me giving you any particular advice or accounting advice, financial advice, none of that. This is strictly designed for educational purposes only. And because the insurance industry in its nature, it changes, just like the financial industry. There are constant changes in laws. Your resident state actually determines your insurance abilities and their laws. Every state has their own insurance laws, but the IRS provides all the guidelines. So everything that I'm teaching you tonight is applicable across the board. But if you're watching this recording a few years from now, some things might actually change or be updated at that point. So this is as of September 2024. And why do I have this conversation? When I'm working with clients, at the end of the day, my role is to be a holistic financial professional, a financial advisor, if you want to call it that. And a lot of times people are coming to me because they have financial problems. They want to better their finances. They want to save money, invest it, whatever. They're trying to retire. They want to save money for their kids, whatever it is. The company I work with, we use an approach to give folks a roadmap to, looking at their financial situation. We call it the 7 money milestones. This is your roadmap to financial security and independence. Now, I will tell you, in my almost 20 years of being in the financial industry, working with hundreds, probably thousands of people at this point, I will tell you that I have never met anyone in my experience who had their whole complete financial picture 100% buttoned up. They didn't need no help from me. Never. Even your most richest, wealthiest person. I do have several folks who fall in that spectrum. Have a lot of folks who are, paycheck to paycheck, just getting started, whatever. I'm here to help as long as you care about your finances. But I've never really met anyone who had every single thing just buttoned up before they met me. And for me, that means that there's still a lack of education. There's typically always an opportunity. I just want to dispel the myth of people thinking, oh, that person's rich, so they have it all figured out. Trust me, the quote unquote rich folks don't have it figured out. They actually sometimes are in a worse financial mess than the average person. But anyway, let me stop yapping. We use the 7 money milestone process to really say, like, look, if you're trying to do something better with your finances, if you address all 7 of these areas, you will be fine. Your finances will be fine. And milestone number 2 is proper protection. The word protection, when we're talking about it, refers to all things insurance, not just life insurance. It could be health insurance, disability insurance, long-term care insurance. Annuities might even kind of relate to that as well. And you see, it's number 2. It's milestone number 2 behind 1, which is getting financially educated, which if you're watching this webinar recording or joining me live, you care about the education you're trying to learn. But milestone number 2 is proper protection, which is having a conversation and evaluating your insurance needs. Why is it first? Well, because insurance protects all the what ifs in life, any insurance that we have. I mean, we even have insurance on these cell phones. Like, God forbid I lose my cell phone. Like, what happens? I need the insurance to replace it. But why do we question or not think about replacing ourselves, our income? Your greatest asset to you and your family is your ability to make an income, to bring money into the household. And your other greatest asset is your youth, your ability to do these things while you are still young and healthy. And even if you're not young or healthy, that doesn't mean you shouldn't do anything. But my point is, proper protection is literally the first thing that you should do when you're evaluating your whole entire financial situation. It's not investing money in the stock market. It's not opening up some IRA for retirement. It's not setting up a trust. It is literally making sure you have proper protection in place, because I don't care because my thought process is, if something happened to you tomorrow, your little money in your investment account will not pay for a funeral. It probably won't be enough. If it is, it'll probably be, gone right away. Whereas we could have a life insurance policy in place. If something happens to you tomorrow, your family will get probably thousands and thousands of dollars that will help them greatly. And tonight, it's not just about if you pass away. I'm actually going to show you how insurance can be of a benefit to you while you're alive. But I just wanted to just kind of place, like, why is it important? Why do we even care about this? Because it's the foundation of any solid financial plan. Now, what is life insurance? According to lifehappens.org, they define it as a contract with a life insurance company where you have beneficiaries who will receive a lump sum amount of cash in the event of your death. That's the simple term. You're paying a life insurance company to pay your family a lump sum amount of money if you pass away. And so it's not, a lot of people, I think, first of all, it's hard to think about that, right? Like, at the end of the day, it's inevitable. I mean, I don't want nothing to happen to me. I'm a mother of 3 children. I'll be devastated if something happened to me and I'm no longer here. But it does happen. It will, whether it's premature or expected or unexpected. It's really something that we have to prepare for. And, 44% of families, this statistic is really scary. 44% of families would face financial hardship within 6 months of losing their primary income earner. And that is so true. I mean, how many times have you seen someone who passed away, who made a significant financial contribution to the family, had no life insurance, and then the family loses the home? The family can't send the children to college like they planned. They can't even maintain the same lifestyle because that income is gone. So had they had a life insurance policy in place, at least financially, the funds would have been, replaced, so to speak. But, 44% of families, I've seen it a lot. I've seen it, unfortunately, a lot more than I would like to say. So beyond that, why do we need to apply and qualify for life insurance? First of all, life insurance is not something that you just get. It's not like you can just go to a store and pull it off a shelf. For a good, sound policy, you actually have to apply. You have to submit an application and qualify for it. There's so many types of life insurance, which I'll go through tonight. Some folks, their biggest challenge is just qualifying for what they want. While you're young and healthy, that's the best time to qualify for life insurance. Another thing is, some people say, "Oh, well, Shantae, I have, insurance at my job, life insurance. Like, why should I care about getting something separate? Well, one, we can't depend on our job. Like, what if you lose your job? I mean, it's not like you have a guarantee to never get fired. Or what if you change places and you work at a new career, new place, and with a new employer, your coverage is gone. Now we have to go through them. So at the end of the day, I always recommend that you have coverage that's not tied to a job. You want to have a policy that you own on your own, but definitely take advantage of what the workplace offers, but just don't depend only on that. Also, if you have lots of responsibilities, you want to have life insurance. And what do I mean by that? Typically, like if we think of our progression through life, when we're younger, we tend to have more debt. We have credit card, we have bills, we have creditors. You might have children that you're responsible for, a mortgage that you have to take care of. And if something happened to you tomorrow, those responsibilities don't just disappear. Yeah, maybe the creditors can hopefully if they don't find out you passed away, because they can make a claim against your assets if you didn't know that, if they find out. But if ultimately you have responsibilities, children, family, real estate, you don't want to leave those responsibilities unprotected. You want to have financial means left behind to take care of those responsibilities. Also, again, and we don't want your family financially devastated. I mean, I could tell you horror stories, and it's the really sad stories of families who lost, again, that income, and they couldn't maintain the same standard of life that they had before. Just imagine where your family doesn't have to worry about debts. We hear the term generational wealth. Unfortunately, a lot of us have been passing on debt from generation to generation. You want to talk about true generational wealth? Don't pass on debt to the next generation. Pass on wealth. Life insurance is one of the easiest financial solutions where you can turn pennies into thousands, even millions of dollars. One of the only financial solutions to do that. If you think about old families and that started America, or, they didn't start nothing, but they came here, capitalists, the Rockefellers, the Charles Schwabs. The reason why we know their names, Morgan Stanley, all these people, is because they used life insurance policies. Millions of dollars of life insurance policies that were paid into trusts that are now still, funding and paying for their future generations, and they've been long gone. So we want to think farther than just paying for a funeral. You can have money left behind to take care of your family, really create that true legacy. You care about generational wealth, you better have plenty of life insurance in place. So I think the reason why a lot of folks don't get it, though, is because, first of all, they underestimate how much they need. Again, they think whatever I have at the job is enough, or they might have a small policy. What I see is like a lot of folks, maybe their parents or grandparents might have got a policy for them when they were kids. And that was it. It was something, $10,000, $15,000 when they were children. Oftentimes that's not enough when you become an adult and have your own family. So we either have, if we have any life insurance, we don't have enough, we have little, or we actually overestimate how much life insurance will actually cost. And that's why in this presentation, toward the end, I want to show you quotes, like what are some actual realistic numbers of like, what could something like this actually cost? Life insurance does not actually cost that much when you think about it from a budgetary perspective. Only 59% of Americans have life insurance. And of those, only about half of them don't even have enough. It was funny. I think I was trying to apply for a loan or something, and they really wanted to see like, what do I spend all my money on? Look, I have a lot of life insurance policies. Obviously, I walk the talk. I have like 3 policies on myself. I have a policy on all my children. I have a policy on my mom and my sister and my niece that I take care of. I pay for them all. And somebody was reviewing like, girl, why do you have so many life insurance policies? And I'm like, well, because, XYZ real quick. And they had identified it as wasteful spending. I was like, are you freaking kidding me? Wasteful spending? That just shows how uneducated you are. Well, guess what? My family won't have to worry if anybody passes away. We will be A-okay. Probably couldn't say the same about that person. It was just so crazy that that's how the world looks at life insurance, as this unnecessary thing to spend on. No, it is absolutely necessary. Like if I was down to my last penny, like if things for whatever reason just turned against me financially, I will do whatever it is possible to make sure that I maintain all my life insurance policies. That's the one thing. I'll give up my car, all my food, my eating out, all my clothes. The one thing I would absolutely make sure that I maintain are my premium payments for my insurance policies. All right, guys, don't let me ramble on. Let's talk about some education. There's only two types of life insurance. And I feel it's so important to talk about this because like I mentioned, I've been doing this. I've had my insurance license. This was the first license I got once I got into the industry since 2005. So almost 20 years. Trust me, I'm an expert at this. But what I do see is, unfortunately, some quote unquote life insurance agents who will say, oh, this life insurance is bad, or don't do that, or you're getting taken advantage of. Like, no, idiot, you're just stupid. You don't know what you're talking about. You're uneducated. I don't want you to deal with those type of people. I want you to be educated. So that's why I want to take time to explain the different types of life insurance. You either have temporary or permanent insurance. Any policy you have is either one, either temporary insurance or permanent insurance. We call our temporary insurance term life insurance. Our permanent life insurance, the only two types of permanent life insurance are whole life and universal life. You guys, that's it. That's all you need to know. No, I'm teasing. I want you to be educated about this because, again, unfortunately, even insurance agents don't really understand this. It boggles my mind. Now, look, the easiest way to remember the difference is to think of housing. Like if you're living somewhere and you're on your own, you're either renting an apartment or you're owning a home, right? So term insurance, I equate that to renting an apartment. Let's think about that. When you rent an apartment, you're paying your rent. It's the same amount for the term of that lease, right? So if I have a 12-month lease, I know that when I'm paying for my rent, it's the same amount for that 12-month period, for whatever that time frame is. That's literally how term life insurance works. It's temporary. You're only paying for a period of time, and whatever monthly amount you approve for, that's what you're paying for that entire time frame. As opposed to permanent insurance, this is like owning a home. When you think about home ownership, I'm not a mortgage real estate expert, but typically when you own a home, your monthly mortgage will cost more than renting, right? You're going to pay more for renting. But what do you get out? I'm sorry, you pay more for owning. But what do you get out of home ownership? You have a home that's yours. It's for typically a really long time, maybe your entire lifetime, but not just for a short period of time, for a long time. And you build equity in your home. When you have a home, that's the whole point. They're saying, oh, you have equity when you're a homeowner. That's exactly how permanent life insurance works. But, that's all you really need to know. One is temporary. It's lower cost for a period of time. The other one is for a long, usually your whole entire life, but you build some equity. There's some value that you get to home ownership. So with temporary insurance, just a couple features listed here. It's just 7, but there's just a couple to highlight. Again, whatever policy you're approved for, your costs are locked in for that time. Now, once that time period ends, I would say most life insurance policies with term life insurance would be anywhere between 10 years to 30 years. Some life insurance companies even do 35 years. So you're paying a same amount for that whole entire time frame. It doesn't change. It doesn't go up. It doesn't go down. However, line item 3 here says over time payment goes up. And what I mean by that is once that term ends, if you are going to try and get a whole new term policy because you've outlived it, you're still alive, your new rate, your new cost will now be at that age, 10 years later, 30 years later, however, many years later that you had, that you've lived beyond that first term life insurance policy. That's what I mean by it goes up. And so if you maintain that contract beyond that agreed upon term, the payment will go up actually every single year. Or what happens is most people they cancel it. They don't need it anymore. They're like, I'm done. I don't need to maintain the policy. So with term insurance, just like with renting an apartment, you don't build any equity. There's no cash value in that type of policy. Some term insurance, you can get a refund of a premium. I don't deal with those companies that do that, but some companies do offer a return of premium, but that's not cash that's growing. It's just some of the money being returned back to you. 97% of the time, the coverage ends because you typically outlived that term. Most people don't pass away within 10 years or 20 years, even not even 30 years. So it's literally just it's ideal for a period of time. I will say, though, some people will be like, oh, I don't want term insurance. I don't get anything out of it. No, that's not true. Actually, most good term insurance companies that offer a term, they have living benefits built into them Whereas if you get like sick or an illness, you can actually qualify to access a portion of your death benefit while you're alive to take care of yourself and that illness. And it can be convertible. Maybe you can't necessarily afford a permanent policy right now, but so you just start out with term. You can actually convert that policy into a permanent policy, usually within a 5-year time period. And then you don't have to requalify like from a health perspective, which I'll share about later. So with permanent insurance, like home ownership, again, it's intended to be there. It's intended to last your entire lifetime. Most insurance companies will have that policy built to last you through age 120. What does that mean? If you pass away anytime between now and age 20, you'll get the death benefit. If you just magically happen to live to age 120, they just endow the policy and they just give it to you. They're like, look, you've lived long enough. Here's the death benefit. You don't have to pass away at that point to get it. But because of its permanent status and its many features, the costs are higher. They do cost maybe, I would say, at least 2 times the cost of a term policy. However, your payments have some flexibility in it. It could be either fixed or flexible. Whereas term, it's just a fixed cost for that entire time period. I think the main reason why a lot of folks are attracted to permanent life insurance is because it does build equity. There's some cash inside that policy that can build. And we say coverage pays 100% of the time because so long as you pay the policy and, you pass away, your family will get that death benefit. And universal life has living benefits. Whole life does not. And guys, if you have questions, feel free to put them in the chat. I'll be happy to address those. Don't put your personal information in there. Some people will tell their life stories. Don't put your personal business in there, but I'll definitely address any questions as they come up. So if you're thinking like, okay, I really like that permanent life insurance thing, let me break down the 2 types. And again, I want to harp on this because oftentimes, like when I have conversations with folks and they think life insurance, the first thing they say is whole life insurance. I'm like, oh my God, like, okay, I get it. Whole life insurance is pretty popular because it just like what was available back in like the 80s when it first was like really popular and a lot of people were getting it, the 70s and 80s. But oh my God, insurance has evolved since then. I call whole life insurance is like equivalent to like having an old brick cell phone. Like that's how old school it is. Universal life is like having a smartphone. It's up to date. It has much more features. I will say neither one is bad. They serve their purpose. But because again, in my experience, most people don't know there's more than just whole life insurance. So here are some features of whole life insurance. First of all, whatever amount you agree to, it's fixed. You're paying that set amount it could be for up to age 100. It could be for a 10-year period, 20-year period. There's different kinds of ways that we can structure how long you actually pay that policy. One thing I don't like about whole life insurance is we don't know what the cost is, like the cost of insurance. What are the administrative costs? What fees or expenses are involved? Those things are completely unknown. So there's no transparency there from the whole life insurance companies. However, whole life insurance does build some cash value, usually via dividend payments. So, and that's not guaranteed. It's if the insurance company pays dividends, will you receive that? And so some people, like if you've heard of infinite banking, a lot of people, when they're thinking of that strategy, I'm not going to go into that tonight. They're using whole life, and it's a very specific way to structure that policy to do that, to build that cash value using those dividend payments. Then you have universal life. So universal life is actually, like I said, the more evolved younger sister, brother of whole life insurance. And there's actually different types of universal life insurance. You have regular universal life, variable universal life, and then index universal life. Universal life, I think one of the key features between that and whole life insurance is that the ability to grow the cash is not dependent upon dividend payments. There's actually different ways that the interest can earn inside these policies. Variable universal life, anytime you see that word variable, that means that the life insurance because there's different types, there's a variable annuities, there's other variable things, but when you usually see that word variable, it means that it's tied to the stock market. So your cash inside of a variable universal life policy is growing because of a sub accounts that are invested in the stock market. So they go up and down with the market. If the market's up, great, your sub accounts are up. If the market is down, you can lose money. So that's the only caveat about that. Index Universal Life, I would say is the most popular right now. I really like this strategy because instead of being directly invested and tied to the stock market, it just follows indexes that track the stock market. So, for example, one very popular index that a lot of people hear about is the S&P 500 index that tracks the top 500 companies in the US. It's actually 503 companies on that index. So when those companies collectively do well, that S&P 500 increases in value. When the companies don't do well, the S&P 500 index will decrease. So the Index Universal Life, for example, might follow an index like the S&P 500, and it will grow when that index grows. The difference, though, with an Index Universal Life and IUL is that when the market goes down, you don't lose any money. There's no loss. Very, very nice feature of IUL. So a lot of folks like that ability to capture some of those market gains, but they don't lose any money if the market does not perform well. As opposed to variable universal life, you capture all the market gains, but you can also take on losses. So most people would prefer an index universal life. But again, it only makes sense for certain people. It doesn't make sense for everyone. And I'll explain that why. Your premiums are flexible because you have some cash value. You might be able to skip a couple payments. You can stop paying for a little while. That's if you have some cash built inside the policy where you can get to a point to do that. And then you can start resuming payments again. Your internal costs are transparent. So we're able to go and see, okay, if I'm paying $100 a month, how much of that $100 is for my actual cost of insurance? How much of that goes to the company? How much of that is an administrative fee? We can actually see the breakdown of those costs. And that cash value that I mentioned, it grows inside the policy where you can really get some pretty pretty considerable, decent growth, stock market like growth. I don't want to overestimate and say, oh my God, you'll get the best growth ever. That's not, no. Especially with the VUL, if the markets are doing really well, you capture that. But typically with IULs, there's a range. You have a cap and you have a minimum. So you'll at least, no matter what, you won't lose anything. You'll get zero. We call that zero is your hero. Or you could get up to a certain cap. So you can grow, like in this example, up to 12% growth if the market does that well. But remember, first and foremost, this is not an investment. This is life insurance first that just so happens to have the cash feature. You also have living benefits in here, which I'll talk about in a second, and then long-term care. So when we're thinking about which one works, it really just depends on your situation. And a knowledgeable insurance agent should, one, understand this, because trust me, I've had people, I know some insurance agents where all they sell is term insurance, and they'll talk so bad about whole life and universal life and IULs. And I'm like, oh my God, you're just really uneducated. It's really sad. Some people can only sell whole life insurance, so they'll talk bad about term insurance, so you really want to work with someone who knows the full spectrum and understands it, the full, full scope of what type of life insurance is out there, and someone who can also offer everything. If you can only offer one thing, of course, you're going to talk bad about everything else. So just keep that in mind if you go to someone else and not me to help you. All right. So let's talk a little bit about permanent life insurance more. Why do a lot of folks like it is, one, you get the life insurance first. That's first and foremost. Two, we can add benefits. We can add living benefits, in particular, long-term care. This is an optional rider that we can add to the policy. And you have that cash value that will likely grow as long as you're funding it and paying it properly, that will grow inside the policy. So let's talk about that cash value. As we're growing, let me take a step back. A lot of times when I'm trying to make recommendations to clients about how to grow their money strategically, it's not just in the stock market. It's definitely not putting money at the bank. I want to present to them solutions that solve problems. And one thing I like about the cash value accumulation possibility of permanent life insurance is that, one, especially if you use the Index Universal Life, you get zero market risk. We don't care if the market goes negative. I'm not going to worry about what happened, when the pandemic started and the market went negative 35%. Your cash value in that IUL or any permanent life insurance would not have been affected. You don't lose anything. Then we have long-term care that we can add. And this is another key feature. A lot of folks don't know that cash inside the policy grows tax free. And trust me, when you're trying to really build wealth, you need to care about taxes. You need to understand the type of accounts that you set up and how it's being taxed. And you can pull money out later in life for income, and it's tax free, as opposed to your retirement account at your job. When you pull that money out in retirement, you have to pay taxes. The problem with paying taxes is that when you're retired in your 60s, we don't know what the tax rates will be in the future. Like, the government has a lot of issues, and I'm telling you, we have like trillions and trillions of dollars of debt. I'm pretty sure they're going to increase taxes. I don't care what president is elected. Taxes will change. They will likely increase. We have so much debt. And one of the key ways that any government does to, bring in income is to tax the American population. So anyway, but guess what? Your cash value inside of a life insurance policy, there is no taxes. And there's a tax-free legacy, because ultimately, if you pass away, your family will get that death benefit or whatever's left over in that policy completely tax-free. So like, for example, one of my policies is a $500,000 term. My family will literally get a check in the mail for $500,000. No taxes taken out. They don't have to report it. They could do whatever they want with that money. Obviously, they're not going to. They know what to do. But, why not take advantage of a strategy that it solves so many problems and have so many solutions? Also, with that cash in the future, once it builds up, now let me tell you guys, the cash takes time to build up. It does not happen overnight. That's another reason why people try to talk bad about permanent life insurance, is because they're like, oh, they're stealing your money. The money doesn't grow, or it takes forever to grow. It does. It does. This is not a bank account. This is, again, not an investment account. It does take time to grow. I'm talking 10 years, maybe 15 years before you'll see any decent type of growth. So if you care about the cash value feature, you want to understand that this is a long-term strategy. You will not see any growth in the beginning. You won't. And if somebody's selling you on that idea, they're misrepresenting that particular strategy. That cash will take time to grow, but baby, once it grows, let me tell you, you could potentially have thousands of dollars in that policy that you can use for whatever you want. That's another feature about this type of strategy, is that some accounts, you have to use it for education, like a 529. That's another tax-free account, but you have to use it for paying for education costs. Retirement, you can't touch it till you get retirement age. With cash value inside of a permanent life insurance policy, once that cash value is there and is grown, it doesn't matter your age, you can access it. You don't have to wait to a certain age to access that money, and you can use it for whatever you want. You can use it for a car, vacation, weddings, retirement age. That's your choice. I'll tell you what I do. So for example, I'm an entrepreneur. I don't work for anyone. I don't have a corporation or employer that offers me a retirement plan. I create my own. And I use this strategy, one, for the life insurance and for the living benefits, which I'll talk about in the next couple of slides. But the cash that I'm building inside my own policies are to be used I'm planning to use it for retirement. I just turned 40 this year. Retirement for me is 20 plus years away. So I understand, I have this long-term understanding of, I'm not touching this money no time soon. But guess what? I also use these type of policies for my kids. Why do I have life insurance for my kids? Every child should have a policy. I use it strategically for my children to use to build cash for them, so that when they become adults or young adults, they'll have thousands of dollars inside of a life insurance policy that they can use for whatever they want. Whether I want to help them with buying their first home, or help them with paying for college, or help pay for a wedding for my children, I will be able to do that using the policy, the cash value that's inside of a life insurance policy. I just want to give you those examples. We have to be creative when we're using these strategies. So instead of me having a separate account for college and a separate account for saving for a business or a wedding, I can use the cash value and really fund this to grow tax-free, for the ability for me to pull it out tax-free whenever I want to. All right, guys, let's talk about some living benefits. I mentioned long-term care earlier. This is super important. I think another reason why I prefer like a universal life or index universal life over whole life is because of the living benefits. Whole life insurance does not offer living benefits. It has cash value and it's there for you if you pass away. Other, universal life types of insurance policies, you can add living benefits such as long-term care. I will tell you this. One thing a lot of folks don't understand is that I don't care how much money you have, if you get sick and you need some help taking care of yourself later in life, and you are like, oh, I could pay for it out of pocket. I have all the money. You will go broke very quickly trying to pay for long-term care. Long-term care is not just for old people. It's not just for, I need a nursing home. Long-term care is if you can't do 2 of the 6 daily living activities on your own. Like, think of what you do when you wake up in the morning. You got to get out of bed. You got to go to the bathroom. You have to change into some clothes. You got to feed yourself. You have to move and transfer. Those are what we call activities of daily living. If you can't do 2 of those and you need help with that, you actually qualify for long-term care. And long-term care, the big misconception is people think that the government takes care of these things. They don't. They offer you minimal service. Like Medicare, people think a lot of stuff is taken care of. It's not. It's not taken care of by the government. You don't want to go broke paying for long-term care insurance, or depending on whatever government services they offer at that age. This is a huge, huge benefit. We can actually build it into a life insurance policy to where if you qualify and need these type of services, you can actually get a % of your death benefit paid out to you. For example, like 4 years, you can get like $2,000 a month, $5,000 a month. Anyway, we could structure that to where if for any reason you qualify for long-term care, you'll get that money and you can use it for whatever you want. You can use it to pay healthcare workers, to pay your family to take care of you, to build a wheelchair ramp to your house. You can use that money for anything. And this is just an example of what those costs are. If you needed to go to facilities, or if you needed, like if you wanted a private room at a nursing home, I'm telling you guys, these numbers, this is from 2018, these numbers are not overinflated. If you're interested, long-term care in itself is a 1-hour conversation. But if you're interested, I can actually run a report on your state and show you what the average long-term care costs will be for your state. And you can see that when someone needs this type of care, they're usually needing it for at least on average almost 4 years, 3.9 years. So you're talking about tons and tons of money that someone will need to pay for these type of services. And that's why I said they'll go broke. I met a lady, this was years ago. She was a client to another financial advisor that I was working with. She had like, I want to say like $900,000 in some investment account with him. And because she was single, she had no children, she was unmarried, she was in a long-term care facility. And every month we had to send like $6,000 to help her pay for her long-term care expenses because she wanted, some privacy. And this was like 15 years ago. So that was, at that time, that was even a low amount of money. So I personally seen people drain their savings, their long and their investments that they had just to pay for something like this. All right, let's move on. This is a 1-hour conversation. So other benefits built into permanent life insurance is if you become critically ill or chronically ill. What does this mean? If you have a policy and you're healthy, you're approved, no medical issues, but for whatever reason, later down the line, you had a heart attack, you had a stroke, you got diagnosed with diabetes, something that's significant impact to your, what do they call it? Your lifespan, but it doesn't kill you. Like it's an illness. You'll probably live with it for a period of time, but it's not going to take you out right away. That's a critical or chronic illness. You can, if you qualify for one of these things and it impacts your lifespan to where they're saying, well, now instead of living 50 more years, you're going to live 40 more years because of this illness. You can actually make a claim to the insurance company and they will pay you a portion of your death benefit while you're alive to take care of yourself while you have this illness in place. But it does have to impact your lifespan. I've had clients who even had breast cancer. Because they caught it so early, it didn't trigger the living benefit because it didn't really significantly impact their lifespan. So it does have to be pretty significant. But oh my gosh, like I turned 40. I know so many people in their 30s who've had heart attacks. I know people who are having strokes. These are real illnesses that we see that are pretty common. All right, guys, let me move on. So which should you apply for? Term insurance, permanent. I educated you on the different types and as far as like what's available. Look, I want to just start by saying this. First of all, no one type is better than the other. Everyone's situation is different and everyone's budget, more importantly, will determine which one you should get. I also believe in blending policies. I actually have term insurance. I have index universal life insurance. I have variable universal life, and I do actually have whole life insurance. So I have all of them because I blend them. So it really just does depend on your budget for us to determine like how much you should get. So for term insurance, I would say these are some typical reasons or why someone would consider that. One, you might not just have a huge budget for life insurance. And guess what? That's totally fine. You have a low budget, but you have a huge need. What do I mean by huge need? You still have a big insurable need and responsibility. You have children, you have, a home. If something happened to you, those responsibilities, like I mentioned earlier, they don't go away. You want to cover that at least by getting term insurance. You get the maximum protection at the lowest cost. Maybe your income might increase later. Great. Let's start out with something that's budget friendly, and we can look at a permanent policy later. If you have large debts, if you're a single person, some single people will even tell me like, why should I care about life insurance? It's just me. I don't have children. Well, you probably have debt. You probably plan to have a family in the future. I mean, you want to get it now while you still can. And I would say start with term insurance and have it as a goal to upgrade to permanent later. Let's just get coverage in place. Permanent insurance makes more sense for those who do have a stable income and who do have strong cash flow because it does cost more. And the worst case scenario is you get a permanent policy and you can't afford it and then you lose it because all that money you put in, you lost it. Like we don't want that happening. I've seen that happen. And again, that's kind of one of the misnomers of why people would say, oh, don't get permanent insurance. People can lose it. They don't, they waste away their money. No, it just wasn't structured properly. And that person probably couldn't afford it in the first place. They should have probably had a term policy. Another reason for getting permanent life insurance is just another strategy to grow money safely. Like we talked about, it's a tax-free bucket of money. You really want to leave that legacy and you want to take advantage of those living benefits, having that long-term care, critical or chronic illness, also built into your policy. So I wouldn't say neither one is bad. You just want to sit down with a knowledgeable professional who can help you understand which one is better for you right now. Which one can you really afford? And at the end of the day, just have something in place, have some peace of mind. I'll tell you a story at the end of my situation when I almost thought I was going to die. I'll tell you, it's a true story. I'll tell you at the end. So stay on for that part. All right. So how much should you need? Now you're like, okay, I get it. I need life insurance, but how much? First of all, we're not just pulling numbers out the sky to say this is how much life insurance you should have. There are some guidelines. The first guideline that we use is to have at least 10 times your annual family income in coverage. So if you earn $50,000 a year, that means you should have a $500,000 policy. If you earn $100,000 a year, you should have $1 million in coverage. Now, that doesn't mean your $500,000 policy has to be all permanent. It could be term. A good portion of that could be term policy because that's the cheaper route. And maybe a smaller portion of that can be permanent. I usually like to blend both to meet that insurable need. Another calculation that we use to calculate how much life insurance you should have is called the dime method. This is when we actually factor in like your actual financial situation. We look at your debts. Mr. and Mrs. Klein, if something happened to you, would you like your debts to be paid off? You don't want your creditors coming after your family or your spouse or kids, do you? Student loan debt. Like you want to have that stuff taken care of, right? Yeah. Okay. Let's factor in how much debt you have. We have your income, the 10 times your annual income. Mr. and Mrs. Client, you have a mortgage. Maybe you have a home equity line of credit. Would you like those to be taken care of if you're no longer here? Wouldn't you want your home to be saved? Like some people lost their homes because the homeowner passed away, the breadwinner passed away rather. I have mortgage insurance. Well, that mortgage insurance is not for you. That's for the creditor. That's for the lender. Do you want to have insurance in place so that if something happens to you, your family could pay off that mortgage and they don't have to worry about it no more? They could stay in their home. Yes. E is for education, but this is kind of like an open-ended one. If you have children, Mr. and Mrs. Client, would you like to estimate calculate having money set aside for your children so that they can go to college if you're no longer here? Yes. Let's figure out what that amount could be. If you don't have children, it could be leaving money behind for other family or relatives, nieces and nephews. It could be leaving money behind for your church, for your tribal nation, for a nonprofit that you really care about. Like it doesn't just have to be, again, we have to think beyond, I'm just having life insurance to pay for a funeral. This is how we really create a true legacy, by making sure we have the right amount of protection. And again, it's okay if you don't meet, in this example, a husband and wife, almost basically $1 million in life insurance. It can be a blend between term and permanent insurance. So someone who should really help you understand those calculations and, determine your budget to see how we can meet this need. Now, how do you qualify for life insurance? So life insurance companies, when you submit an application, most insurance companies, because sometimes if you get something in the mail, they don't look at your health at nothing at all. They just tell you this is what we charge. But any really good policy, they're going to determine your costs based off of your age, your height and weight, any present health issues, past and present health issues, prescriptions. If you're a tobacco user, I'll tell you this, tobacco users, I'm talking about nicotine, you will pay 2 times the cost of insurance compared to someone who's a non-smoker. Sometimes insurance companies will ask about family history. For example, I know some insurance companies will say, like, if you had a parent die at a young age, like 50 or earlier, they'll question that, like, what was that from? How did that happen? They'll look at your driving record. You will, if you have a driver's license, they will run a check on your driving history. Insurance companies don't like DUIs. If you had a DUI within the last 12 months, probably none of them will cover you. Some insurance companies don't even like DUIs within the last 2 years. They just see it as a reckless behavior. Criminal record. If someone is currently in jail, I've had this question before. My brother's in jail. Can I get a policy on him? No. No criminal records. I'm not going to say nothing like felonies, nothing major. If you little shoplifting or something, they'll cover you. But the insurance company is trying to determine your lifestyle. What's your level of risk to them of you passing away? High risk activities, like if you like jumping out of airplanes, scuba diving, race car driving, flying airplanes as a non-commercial pilot. Maybe you have a high risk job. You're a window washer on a skyscraper in downtown Chicago. High risk activities. Insurance companies will ask about some of those things. Again, because they're trying to determine, like, at the end of the day, this is a contract with an insurance company. If something happens to you, they write that check. They send that thousands of dollars to your family. So they want to do their best due diligence to determine, like, what is this person's medical history? Is there a chance they could have an early death? They know they have mortuary tables that they look at. They can literally look at your age, your height and weight, and they can estimate when you might actually pass away. It's pretty freaky, actually. So when they go through, this is a process called underwriting. So they'll do that background and then they'll look at, okay, we'll approve them and we'll give them a rating, a health rating. And that health rating will actually determine your cost of insurance. It could be super preferred, standard. There's different like levels of like the health rating. Obviously, like something like super preferred means that you're the healthiest. You're like, you qualify for the best rate. So that means your costs will also be the lowest. You could even get table rated. This means you might like have some pretty significant health issues, not enough to where they'll decline you, but they just might charge you a little extra for that health issue. So every person is completely different. I would say, me, for example, I work with over 100 financial and insurance companies. So we can shop around. I don't represent just one company. So if someone is honest with me and kind of upfront about, hey, this is what I have going on, this is what I take prescriptions for. With me having that knowledge, I can actually shop around and I know who to apply to and who not to waste our time with. So don't think that, I have a health issue or I'm too old. No, you can get insurance coverage. There's plenty of companies out there. Again, you just want to work with an agent who has access to different options to shop around for you. All right. Now, I want to show you an example of like, how does this all work? So you all see this example from Nationwide. It's actually one of our companies that I work with. This is an example of an IUL. It's an Index Universal Life Insurance policy, a real life one. I'm not making recommendations. This is just for hypothetical purposes only. But in this illustration, I'm not going to go through these little numbers. They're so small. But this person is applying for a $400,000 death benefit. So it's a pretty significant death benefit. This is a 30-year-old male, preferred non-tobacco. So he's healthy, non-smoker, 30-year-old male. He's paying $300 a month. So that's his money that he's putting into the policy every single month. In our example, that cash value is growing at 6%. So pretty standard. These policies can actually grow way better than 6%, but we're keeping it conservative here, 6% growth. And it says starting at age 30. So he starts at age 30 and he's keeping this policy, up until he passes away. So by the time, let's say he started is putting $300 a month at age 30, and now he's 70. He's already retired, but he's like, you know what? Now I want to start pulling money out of this policy for the rest of my life. All right. Let's look at how that works out. So from 30 to age 70, he put in $144,000. So over a 40-year time frame, he put in over $144,000. That cash value at that time when he's age 70 is now $454,890. So that cash, so he put in $144,000. Mind you, there's costs coming out for the insurance, administrative fees, little things like that. And that cash growing at 6% is now $454,000. And at age 70, he says, you know what? I want to actually turn on income. I want to pull out money from this policy every year for the rest of my life. Well, not the rest of my life, until I turn 100. He's able to pull out $33,000, over $33,000 every single year, tax-free for 30 years, which represents $1 million, over $1 million in tax-free income. Now, this is a very well structured example. I actually didn't do this. Another one of my colleagues in Cleveland put this together. But this is the power of someone leveraging properly an index universal life policy. It's properly funded. He's actually, his premium payment is $300 a month, but his cost of insurance might be less than that. It's probably like $150, but he's actually putting in more than what's required because he's growing that cash. So that put in $144,000, it grew to $154,000. Mind you, all this time, he's had $400,000 of life insurance coverage, and he pulled out over $1 million over a 30-year time frame. I mean, this is like chef's kiss, so good of an example. Does it happen like this all the time? No, but can it? Absolutely. I mean, this is what I'm striving for, something like this right here. Now, I realize $300 a month could be a lot of money, right? Some people just don't have that. Some people do, some people don't. And this is an example. I mean, we could structure these things in so many ways. This is a male policy. Female rates are different. It doesn't have to be a $400,000 benefit. This type of strategy actually starts at $100,000. There's so many ways to structure this. This is just an example. But let's say we have that same 30-year-old guy. He's like, I can't afford this permanent policy, Shantae. I like it. It sounds good, but I can't afford it. Okay, fine. Let's look at term insurance. Remember, I said term insurance is so much cheaper. Same company, 30-year term. So this is for a period of time, 30-year period of time. 30-year-old non-tobacco preferred male, same death benefit, $400,000. But do you see how much difference the cost is? $40 a month. $300 here versus $40 here. So I could tell that same young man, you know what? Let's make this IUL a goal. You can't afford $300 a month. That's totally fine. But can you afford $40 a month for a $400,000 policy? We're comparing the same death benefit. It's just a different type of policy. That's an example of the difference between term and permanent. And I know for sure this permanent policy is built for them to maximize the cash value. Here, for someone just getting started, they just want to start, having some protection in place. Anyone could afford $40 a month. I don't care who you are. And most times I'm doing an application right now. I quoted the young lady, she's 40, she's my age, 40 for $100,000 30-year term. And her rate was like $18. Like, she could afford $20 a month to pay for a permanent life insurance policy. So I just wanted to show two real life examples. Again, I'm not making any recommendations. I just want to illustrate to you the difference. What does this actually look like from a cost perspective? All right, so let's talk about the application process and then we'll wrap up here. So first of all, you really want to work and find a knowledgeable and unbiased financial advisor like myself, or an insurance professional to work with. Insurance agents are not financial advisors. We have different licenses. Yes, I have an insurance license, but I have many, many more. I'm not saying an insurance agent can't help you. There's great insurance professionals, but you work with someone, like myself or an actual, just a regular insurance agent, you want somebody who's educated, who can offer you term, whole life, universal life. You want someone who can offer you everything, because in my opinion, if they can offer everything, they won't be biased. They're not just going to try and sell you only term. Some companies say buy term, invest the rest. I don't agree with that. Some people say, oh, whole life is it because that's all they offer. Anyway, get different quotes. Just as easy as I was able to show you a permanent quote and a term quote, those people should be able to do the same. You want to just get different options, because different insurance companies, they do quote differently. It's not that drastic, but some people even look at different medical conditions differently, whereas one company might decline you on a medical condition where someone else won't. So you really, again, want to be open and honest and share about your health history, so your insurance professional can really find the best solution for you. And then we submit an application. So there's a couple ways we could do this. We could do most times, 99% of the time, what I do is a trial application. I can submit an application to an insurance company to see if they would even approve you. Like, I don't want to waste my time making you put money up and all this and that, and you'd get declined or it doesn't work out in your favor. So I typically do trial applications just to see what your insurability is. Because you could be telling me I'm healthy, I'm great, and then something else comes up on your health medical history that you forgot to tell me. I've had that happen before. Somebody forgot to tell me that they were on kidney dialysis. I was like, had you told me that, I wouldn't have wasted my time applying with this company. But anyway, so you could do a trial application. You can also submit an application with the first month's premium. And if you do that, you're getting what's called a conditional receipt that says that if you apply for this life insurance, you submit all the requirements that they need to review your policy. And let's say you pass away. Something crazy happens, you pass away before that policy is actually approved. Because you put down that conditional, that first month's premium, and you said, hey, I want to have coverage right away, you have that conditional receipt, your family will get that death benefit, so long as you submitted everything that insurance company needed for them to make a decision for you, and you ultimately, untimely passed away before the policy was even put in place. So if some people do that, I don't require it, but if you can, it doesn't hurt to do that. Insurance companies, when they get your application, then it goes through an underwriting process. So you typically will sign off a HIPAA authorization form. Guys, I'm gonna go about 5 more minutes and then we'll be done. You'll sign off a HIPAA authorization form where it gives the insurance company the authority to go to your medical providers. They'll look at your medical records. So again, you might not disclose to me certain health issues, but they'll find them. They will find it. Some companies, sometimes they just do an online health questionnaire. They really do. What I noticed, especially since COVID, since the pandemic, insurance companies have really transformed their processes to try and do as much as they can electronically without having to make it complicated for you. So most times they'll just do a health questionnaire. Sometimes they might request a phone interview, or I wouldn't say worst case scenario, but sometimes they'll send a paramed examiner to come to your home and to draw blood and urine. I actually haven't had no one have a paramed exam, like I said, since COVID. So most times they could just look at your health records electronically and they'll be able to use that information to make a decision. A couple things too, you want to make sure you have seen a medical professional within at least the last 2 or 3 years. If you haven't seen a medical professional, they might find that problematic and they'll say, we don't have enough information to make a decision. Go see a doctor and then reapply. All right. So that underwriting can take 1 week, 4 weeks, maybe longer. It really depends on the insurance company. I've seen policies get approved actually in less than a week, like literally 4 days. So it depends on the insurance company, and they will either approve your application as you applied for. So you know your costs, you know exactly what we're getting. Sometimes they'll make an approval. They'll say, we'll make an offer, but we want to change this because we found something in your medical record. Or if you get the unfortunate decline, they'll let you know, we found this was not acceptable for us. And, you can get that information if someone declines your application. And then once that application is done, you just start making your payment premiums. We usually have this set up automatically to draft from your bank account every month, so it comes out on time. And I always tell folks to review your policies at least once a year with your insurance professional or your financial advisor. Now, real quickly, I wanted to mention this because it's not life insurance, but it's so important. When you're naming beneficiaries, it's very, very important to understand the different types. You have primary beneficiaries. And remember, beneficiaries are the people who, if something happens to you, they get the money. Your primary beneficiary, whoever you name, they receive the value of that insurance policy at the time of your death. That can be one person. It could be multiple people, so long as they split. Like you could say 20% goes to this person, 30 goes to this, 50% goes to whoever. It doesn't matter the split, so long as it equals 100 if it's more than one person. You can also name a contingent beneficiary, and I do recommend this. This means that they're next in line. So let's say you pass away and your primary beneficiaries are passed away. Then your contingent beneficiaries will be next in line to receive that money. I always recommend at least name one contingent beneficiary. It's not required, but the reason why I recommend it is because if all of your beneficiaries, you and your beneficiaries are passed away, then that life insurance policy is paid out to your estate, and then your descendants will have to go to the courts. It's a mess, go through probate, all that stuff. Try to avoid it. Naming beneficiaries are the easiest way to avoid that. One quick thing about kids. I get this all the time. Some people are like, well, I want to name my 2-year-old baby as a beneficiary. I highly, highly advise against that. You do not want to name a minor under the age of 18 or age of majority in your state as a beneficiary, because they won't have access to that funds, to those monies. An insurance company is not going to write a $500,000 check to a 2-year-old. It will actually be held up. It'll probably be like a guardian or a conservator or something, to where if there's money in the name of that beneficiary, it'll be under the control of the courts. It's a mess. If you're concerned about that, you want to have a trust established and then name your trust as a beneficiary. That, my friends, is a whole nother conversation. All right. So at the end of the day, when you have proper protections in place, you have financial security. You do feel secure with having the right amount of insurance place, having, knowing that you're growing cash value, knowing you have living benefits built in place if you have some serious issues come up.